So in this video, you're going to see me give a presentation to a group that I did live just a few weeks ago from the recording of this video. And with that said, you're going to see me talk about two primary types of people. You got number one, the retirement optimizer, and the second person, we have the entrepreneurial investor. So I'm going to delve a little bit more into that in the actual presentation in and of itself. And I think what's even more valuable is the very end of the video, because then is where we talk a little bit more about the questions and answers, right? People like yourself have questions about whole life insurance, about how to structure it, about all these things. And so a handful of those questions are asked in real time towards the end of the presentation. I'm able to actually answer those, of course, in real time for you as well. So sit back, relax, enjoy the video, and let me know what other questions you guys have in the comments below. Thanks for watching. Well, first and foremost, I want to thank Danielle for putting this together. I was able to kind of work with Danielle a few months ago when it comes to all things that I'm going to be talking about today when it comes to life insurance, but definitely a less traditional view of how people tend to look at life insurance is what we're going to talk about today. But I think it's first and foremost important for me to kind of share who am I. My name is Demetrius Walker. I've been in the insurance industry, specifically as in the financial world, for the better part of a decade. When I started my career, I would call myself the jack of all trades, but I was a master of none. And so I got in, I'm thinking I'm going to help people insurance and their life insurance and their health insurance and their disability insurance and their investments and their retirement plan. I'm going to do all these things, and I'm going to do them the best way that anybody ever could do them. And at the same time, as I started to go into the career within my first year some time ago, I thought to myself, there's no way in the world I can be the utmost expert at all of these areas and be able to like call myself an expert in all of those areas. And so as I delved more and more into the world of life insurance, I ended up deciding to kind of hone in on that in particular because of the many things that can be done, some of which we'll talk about today in the presentation. And so what we're going to do, I'm going to have the presentation that's probably going to be somewhere in the neighborhood of 20-ish minutes or something like that, maybe 15, 20 minutes. I didn't want to make it ridiculously long and bore anybody. But then what I encourage you guys to do throughout the entire presentation is just go ahead and write some questions down as I'm talking through it, because one of two things will happen. Number one, I will answer those questions along the way that's kind of coming up. Or number two, we're going to leave some time for questions at the very end. And by no stretch of the imagination am I in any particular rush for you guys. I'm here for you guys this evening. So ultimately, what I'm going to be doing is talking about a couple of different things. So generally speaking, the point of today's conversation is to hone in on what is this overfunded whole life insurance or overfunded life insurance and things of that nature. Who is it supposed to be used for? What's it for? Like what is this whole life insurance thing? And that's really what I'm going to be getting into. But more specifically, I want to talk about the two types of people that it makes the most sense for, from a standpoint of just high level, two types of people. And so, and just to give you guys a little bit more background, I run insurancestrategysolutions.com. And again, like I said, I've been in the industry here for the better part of a decade, and it's been a blast to be able to serve in this sort of capacity throughout my career. So let me keep going from here. First and foremost, let me talk about the four core benefits of high cash value life insurance from the very beginning, especially when we're talking about this term of it being overfunded whole life insurance. Number one is that it keeps your capital safe. The second is that it grows your capital very predictably. The third is that it protects not only your family, but also yourself. And we'll kind of get into that, especially with the retirement optimizer. And then you're able to utilize it strategically throughout your life, especially if it's set up and used properly. Okay. So the two types of people that we're going to talk about here, and this is really me basing this off of the thousands of conversations that I personally have been able to have over the past 8.5, 9 years or so. Really what I found is that people tend to fall, generally speaking, right, into two primary categories. You're either A, going to be a retirement maximizer, or B, you're going to be perhaps maybe an entrepreneurial investor, or maybe a combination of the both. And I think a lot of this is going to revolve around the legacy that can be left behind as well. But the retirement optimizer, high level, is those folks who are focusing on building a nest egg. Maybe they got their 401k, their IRA, this, that, and the third, but then they also want to create something safe on the side. And I'll get into a little bit of that in a moment. Whereas the entrepreneurial investor, those are the types of people that's like, hey, as I'm sitting idle for opportunities that may present themselves, as my money is sitting idle for opportunities that may come up, I want my capital to be safe. I want it to be growing. Even when I go out and use that money, I want control of that capital and just readiness to capitalize or take advantage of opportunities when they come up. Okay. And so throughout the rest of the presentation, be thinking about which one of these people or these categories of people, if you will, do you resonate with the most, or perhaps even if you resonate with both of them in a combination. So just to expound a little bit more on the retirement optimizer, these are for those who are already just very diligent in terms of their savings. Not just bank accounts, but even Roth IRAs and 401ks and 403bs and 457 plans and this, that, and the third, right? We got brokerage accounts, like I said, bank accounts as well. So they're very disciplined in how they go about, and how they go about saving. And their primary goal, retirement optimizers, their primary goal, again, is to build a nest egg that's large enough to support them in a retirement phase of life once that time comes. Okay, that's really what their primary goal is. And so one of the things that's important to distinguish when it comes to the retirement optimizer, just like retirement in general, and I would even say that this is one of those things that not a whole lot of people really think about per se and kind of separate the two, but there's really two phases of retirement income, right? Number one is the accumulation phase. So we're talking, think of it from a standpoint of like climbing up a mountain. If the mountaintop is retirement, the retirement day, well, climbing down the mountain is also going to be important. So we're going to talk about the accumulation phase and the distribution phase. So accumulation phase is one of those situations where it's like you're adding money to your investment accounts. Again, 401ks, 403bs, IRAs, Roth savings accounts, what have you. And the thing about that accumulation phase is that it really does not impact the person saving on a day-to-day basis, right? In other words, the volatility, the ups and downs and the market swings and all this crazy stuff, it really doesn't impact us on a day-to-day basis because we have our income coming in from our work, from our job, from our business, things of that nature. And so what's important to note too is that when it comes to this phase as well, usually there's a little bit of time for recovering when the market does tank, right? But then we transition into the distribution phase. So just like, again, climbing up the mountain is one part of the whole example, climbing down the mountain is just as important. And that's just coming down the mountain very safely. And so what a lot of people find themselves in is a scenario where perhaps they have just a 401k or just an IRA or something that's all tied to the stock market in one way, shape, or form. And so their entire income trajectory is 100% based on how the stock market performs. Right? Another way of saying that is their entire, income projection is based on the emotions of other human beings and how they deem a stock to be more or less valuable at the end of the day. And so during this phase, all of this volatility up and down of the market, that has a much more significant impact on their psyche, has a much more significant impact on how much income they can take out, has a much more significant impact on the longevity of their income, because of the simple fact that if I pull money out because I need it for retirement, I got to live my life, but then the market also drops by 13% or 22% or what have you, like you're kind of doubling down on the losses. And so the main fear of a lot of these, retirees is like, my goodness, what if I run out of money, right? All because they're tied to one asset class, which is usually just the stock market or what have you. And so the overarching problem with this is that, again, most retirement plans almost entirely, if not just 100%, relies on very volatile assets in order to create an income that we want to be very stable. And so this leads to something called sequence of returns risk. Maybe some of you have heard of this before or some variation of it, but it's really, the way I like to describe it is, it's the risk that you run out of money too quickly, or it's the risk that the stock market just doesn't pan out in your favor, right? Especially at the time that you want it to pan out in your favor. And so that results in uncertainty in the income that you can produce, or again, the longevity of it. And then for those who really deeply care about leaving an inheritance, leaving generational wealth to your children's children and things of that nature, by having your entire income from retirement perspective relying upon the volatile markets, you're actually going to reduce how much legacy you can leave to the next generation as well. Okay, so those are some of the core problems with this. So this is where, like, how life insurance or overfunded whole life insurance kind of comes into the picture. What it does here is it actually smooths out retirement income because it creates a non-market source of funds that is not volatile. And in fact, you're only going to be increasing in value of your policy year after year after year. And so how this works with a retirement optimizer is it serves as a buffer for the volatility that's inevitable, right? Just because once a person may decide to retire does not mean that the market's going to like slow down with it. The market's still going to do its thing. And that's where a large sum of so many people's retirement income is coming from, right? And so here's how it ultimately would work. In those years where the stock market does incredibly well, perhaps it makes sense to take out of the 401k or the brokerage account or the Roth or what have you. But in those years where the stock market tanks, it's down 10%, it's down 20%, 35%, right? In those years, that's when you can tap into your very safe, non-volatile cash value within your life insurance policy. But why would you do that, though, is the question. The reason you would do that really just boils down to allowing both of these assets to work well with one another. When the stock market isn't doing great, we hope it can recover, but the only way it can recover is if we have another source of funds to allow it to recover. And that's how life insurance fits into the fold, okay? And then, of course, there's the guaranteed death benefit protection that comes along with this as well, simply by incorporating life insurance into the picture. That's well structured. It's specifically designed for cash accumulation while also having a death benefit alongside it, okay? Next, we have not just the retirement optimizer, but the entrepreneurial investor. So we're specifically talking business owners, real estate investors, people that are seeking opportunities to invest in XYZ sort of an investment. And these are for folks who are, like, think about the folks who are, again, looking for those opportunities. They may need it for their business to reinvest back into their business. They may need it for emergencies that may come up within business or otherwise. And so the entrepreneurial investor type of person is one who's like prefers liquidity and control over their capital no matter what, right? That's what they prefer because they know that they can go create a greater rate of return and a more predictable rate of return than perhaps maybe the stock market or what have you can create for them, okay? Now, in order to create this liquidity or just kind of keep this liquidity, usually the entrepreneurial investor, they're storing their money in where everyone's pretty used to, perhaps bank accounts, because of the fact that they're highly liquid. They're very, very familiar to all of us, and they're viewed as safe places to store money, which, I'm not going to refute that, although there's some arguments that can be made. I'll save that for another day. But I will say bank accounts can create some disadvantages though, because there's returns that happen within your bank account. But at the same time, those returns are not guaranteed. Those returns can change out of nowhere. The returns tend to be pretty low. And the reason that they can change a lot is because these rates that perhaps banks may give can oftentimes be based upon promotional rates from the Federal Reserve. And another thing about the bank accounts, though, that's can be a disadvantage oftentimes is simply the fact that there's interrupted compounding that's happening. And I think that can go significantly understated of like, if I can have X percent compounding and growing and compounding and growing and compounding and growing throughout the rest of my life without it ever being stunted with the growth, there's a huge value add there. And so that's not something that you get with bank accounts. And also, bank accounts, they're not built to pass on wealth very, at least not very efficiently. Whereas life insurance, not only are you building cash accumulation, cash value, but you have this death benefit that's been growing the entire time. And I'll show you that probably in a few minutes here. Okay. So how life insurance, how high cash value, specifically life insurance, fits into the fold is that it's more efficient for long-term storage of capital for opportunity. The growth is going to be effectively tax-free, and your access to that capital is also tax-free. Now, you'll see a note in here that says cash value grows tax deferred. I put that in there as a technicality simply because of how the IRS sees it. But in terms of accessing the life insurance capital, you're able to utilize that tax-free every time. Also with this, there's uninterrupted compounding. So for those who are investors, they're going to go out and earn their 12%, their 15%, their 37%, their 200%, whatever it is in a sort of an investment. Usually, if you take it from a bank account, let's use an example. Let's say, for example, someone has $100,000 in a bank account, just as an example, but they're an investor and they see an opportunity. And that opportunity is going to cost them $20,000 to get into or something like that. Well, with a bank account, now you got to withdraw 20 grand to put into the investment. Nothing inherently wrong with that, but might there be a better way? With life insurance, how it works is you have, for example, $100,000 in cash value. You can actually borrow against your policy in the tune of $20,000. And what happens is your entire $100,000 in this example would continue to grow as if it were never touched. That's one of the powerful components that you get just by having a properly structured whole life insurance policy. When it comes to the legacy and leaving a legacy to your children's children and just kind of generational wealth, this is where life insurance shines the most. And in fact, that's why it was created from the very beginning, right? There's a guaranteed death benefit that's going to create an instant tax-free wealth transfer to your kids, grandkids, to church, or whomever that may be, because that's what it was designed to do, right? And you're going to leave a multiple to a large degree of what you've put into it, simply because we have actuarial science working on the side with life insurance. And last thing I'll say here is just the better long-term control. In other words, you're getting greater growth. You have access to more of it. You have control over it at any point in time, and way more protection than bank accounts tend to offer as well. Okay. So this leads me to policy designs more specifically. This matters a lot because on one hand, you may hear, well, it's possible that some of you have heard maybe some other talking heads on the internet saying that like life insurance in general or whole life insurance or what have you is just like a terrible place to store money. And I think I would agree with them in terms of the types of designs that they're looking at. So we're going to look at a poorly designed policy that doesn't have great growth, that has much higher cost. And then we're going to look at a properly designed whole life insurance policy as well that is designed for cash accumulation and the overfunding that's happening. And so that's kind of what we're going to do here in really right now. Just to specify it a little bit more, though, the poorly designed policy that we'll see, again, there's excessive fees and commissions. In other words, if somebody's premium per year is $10,000, just to keep numbers round, I mean, a poorly designed policy, there's going to be $0 of cash value, which we'll see in a moment, and a lot of that is actually going to the life insurance agent, right? If not all of that. And so that's where, in terms of the work that I do, I want to make sure that I don't design poorly designed policies. And I understand how large of a pay cut, quote unquote, that I personally will be taking. And I'm okay with that because I would rather have money growing in your favor than to have money growing in my favor, because at the end of the day, this is a product for you and it's helpful for you in order to be able to implement whatever strategy you want. Poor design also has slow cash value accumulation. And again, as you can see in a moment, very limited control of money as well. So I'm not sure how well you guys can see this. Let's see if I can maybe blow it up a little bit. Maybe not that well. I don't think it lets me blow it up. But what we're seeing here is premium of $12,000 per year, just as an example, like $1,000 a month is where you're saving money. That's this middle column. We have cumulative premium, so all that you've put in over time. So let's just look at year one as an example. Year one, okay, we got $12,000 that's gone into a policy, but then there's $0 of cash value. It's like, wait, all this money I put in and there's nothing to show for it. The thing is, you do have a death benefit, that's cool. But if the purpose is to utilize it for retirement, the purpose is to utilize it for opportunities that may present themselves as an investor, it's like, I want more money here than $0. After 2 years, you now put $24,000 into this thing, just as an example. $300 is what you have access to. Very, very poor design. To a point where, let's say 20 years down the line, you've put $240,000 into it as an example over 20 years. You do have $339 available, but it took forever and a day to get to a point where you have more access to capital than what you've put into it, okay? So now let's talk a little bit more about an optimally designed, a well-designed policy. This one's gonna have significantly lower costs, significantly higher efficiency, cash values building a lot quicker. You have way more control over capital. You can utilize it for literally whatever you want to. And you're maximizing your tax advantages from a standpoint of the money you got access to, but then also the death benefit that you leave and things of that nature. So I want to just highlight that as well. So in this particular design, we have, again, the same $12,000 per year going in, but look at the difference. We have this $9,700 of cash value in the first year. And the only reason that there's not dollar for dollar access is because it is life insurance at the end of the day, and there has to be death benefit that's being purchased, right? And so by that fifth year, you've put in $60,000, you have access to just shy of $60,000. Sixth year, 72 grand as an example, over that course of time has been put in. There's just shy of 75,000 available by that point. For 20 years, 240,000 has been put in this example. Almost 397 available for you to utilize for whatever you wish, for buying that next business, for borrowing against it, to investing your own business for supplemental retirement income, right? It's better to have greater cash working in your favor than to have it working for the favor of someone else. And that's really the point that I'm getting at here. Okay. So I guess the question that I'll somewhat leave you with here is like I mentioned before, which category best resonates with you? I know we talked a little bit about the retirement optimizer. We talked a little bit about the entrepreneurial investor as well. And it's important to consider, like, how do I see this applying to me? Because it's one of those things to where we don't want to randomly just create a policy for anyone, but we want to be able to solve a particular problem or accomplish a particular goal, right? So there's a whole lot more, I guess, technically that I could have gone into, but I, again, didn't want to bore you guys by any stretch of the imagination when it comes to all that I could share. I just wanted to kind of give that high level overview, share a little bit of the numbers, but I'm happy to have questions and really go through any questions that you have. One other thing I'll say, and then we'll open it up for questions, is when it comes to creating this for yourself, ultimately, the type of conversation that I have with people revolves around talking about what it is that you're looking for, identifying, for example, the type of category, quote unquote, that you're in. We take a look at the numbers and make sure that the numbers align with the goals. And then, of course, we create the strategy along with the illustration or the numbers as well, okay? So again, I said a whole lot, but I want to open it up for questions because I got time on time right now. So I'm happy to help in any ways that I can in terms of questions that you guys have. So I hope it made sense. And again, I'm happy to speak with you guys with any questions that you have. Any questions?
How would you structure something that not as long term, something short term? When I say short term, like within 5 years.
The way that I would do that is that, and I've actually done this as recently as I sent it over to a client just yesterday, or no, today. There was a 7-year time horizon, so a little bit longer, but yeah, the same principle applies. Ultimately, there's going to be a setting that I can create within the software that says, hey, I just want to have this funded for 5 years, or just for 7 years, or 3 years, whatever it may be, and allow that cash to just keep growing, even if you're no longer putting money into it after 5 years. And so I usually like to give people flexibility and options, though. What I mean by that is, if they only want to fund for 5 years, that may actually pan out to be that way, but it also may pan out to, man, I want to add an extra year. Or you go a few years without funding, and then maybe in the 9th or 10th year, you want to fund something. And so I tend to keep the option on the table to be able to continue to fund. Does that help answer the question? Or feel free to probe as well. I'm an open book.
That does answer the question, because I don't want it to be something 20 years. I would rather have something that I can, in 5 or even 7 years, something I can touch,
Right. Now, what's cool is you're able to access that capital from pretty much day one. I like to say 30 days after you start the policy, whatever amount of capital you have in it can be utilized for whatever you wish, technically. And you don't necessarily have to wait until 3 years out, 5 years out, 10 years out to fund the policy. And also, even when I structure policies that show 30, 20, 40 years of premiums, you have the option to turn that off at any point. And that's one of the drawbacks, I would say, to life insurance illustrations and these numbers, is that it just gives us a snapshot in time. It doesn't quite give us all the particulars about the flexibility and things of that nature, which is probably something I could share another illustration here in a moment, but that's probably something that will be helpful for explanation as well. Good question. Any other questions?
I have. Oh, sorry.
Go ahead.
I have a. I don't know if it would be considered have valued life insurance policy, but what would I be looking at on my current policy that will let me know whether I need to dissolve it and move it to the policy that you're discussing, and what would be my drawback of losing all of these funds that I've put into the existing policy?
Great question. So I think what I'm hearing is, you may have a policy already. How can you tell if it's optimally designed or not? And if you needed to pivot it, what would be the disadvantages of that? The way that you can tell that it's well designed or potentially poorly designed is take inventory of how much premium, how much contribution you've made to that policy over since the time you got it. And then I want you to take a look at what's your cash value in that policy. Because, for example, if you are, 5 years into a policy, and making up numbers here, you put in $10,000 or 20, well, I'm just making a number, $10,000 is what you put into it, and your cash value is 2,000, not a greatly designed policy. And so in order to make that pivot, some of you may be familiar with real estate. There's this thing called a 1031 exchange. In life insurance, they have something very similar called a 1035 exchange. It's just IRS talk, which is allowing you to take the value of one policy and transfer that into another policy that's more optimally designed. And so when you do that, one of the disadvantages potentially is that maybe the more seasoned policy, the older policy, would have potentially caught up. But that's one of those things where I do policy reviews all the time. Not to keep saying the same sort of statement, but I literally did one earlier this morning. It was a scenario where I can look at side by side and say, hey, life insurance company, will you give me an illustration, the numbers of what this is projected to produce over the next, I don't know, 10 years or 15 years or what have you. Then I would create a policy over at one of the carriers that I work with. And then we just kind of see, apples to apple, what's the numbers going to look like over the long run, right? I had a gentleman, was it 2 weeks ago? He hadn't made any decisions up to this point, but there's a large premium obligation. Like, he loved the idea of these policies. Different agent worked with him, loves the idea of it. He had a really high premium obligation. He's like, I really want to make a change. And I'm like, you can have a significantly smaller premium obligation and create just as much growth. And so that's one of those things to where it's case by case. And I know long-winded answer, but did that help in terms of the process and the advantages / disadvantages?
I mean, yes, it did. And I think I may need you to look at my existing policy and help me compare. I'm going to get that paperwork.
Yes. Great question so far.
So the insurance that you talk about now is whole life insurance, right? Okay. What about index universal?
Yeah.
What about that?
Yeah. Index universal life insurance policies, I would say, is a little bit more on the longevity side, because when it comes to a universal life insurance chassis, I'll call it, when it's built upon universal life insurance, that usually results in 2 categories of accumulated value, is what they call it. So there's accumulated value, which you really can't really tap into early on, but then there's your surrender value, right? So the surrender value is technically the amount of capital that you can actually borrow against. The accumulated value, you cannot. Why? The reason for that boils down to, when you have a universal life insurance chassis, they have this thing called a surrender schedule, or a surrender period. Which all that means is, if you take out your policy on the first few years, you may end up getting a big goose egg in terms of dollars back, even though the accumulated value may have said $9,000 or whatever. And so in terms of use throughout your lifetime, if the idea is to use it in 10 plus years, which is usually the schedule, with the surrender schedule, could make some sense. But usually for those who are investors, or they want to incorporate an element of stability in the portfolio, life insurance is the better move. But I'm not fully against IUL. It's just, I haven't usually seen a lot of great use cases. And I'll give you an example. Have I sold IUL before? The answer is yes. It was last year, and it was a gentleman who effectively wanted a relatively cost-effective way that's permanent to get a specific death benefit amount. He didn't even care about the cash value. And so that's what we were going for him. And so that's usually the characteristics that I'm looking for those who may want IUL. Does that help, or you have more? Go ahead.
Would you have to put that? Would you have to form a trust for that? So that if something happened to me, would I have to? Would they go to, without having a trust? Would you have to go through probate and all that for my?
Oh, great question. Yeah.
So, paid,
right. How life? So in my career, this is like sad to say out loud, but I've had to deliver, quote unquote, 2 death claims. In other words, people that I've personally worked with have died. And it's a weird feeling, but it's good to know that their families were taken care of. And so with that said, there's no probate that comes along with it. Based on current legislation, laws, and all of that, that actually bypasses probate. So there's no trust that's going to be needed, especially for transferring that death benefit from one place to the next. Now, here's where trust can fit into the picture, though. Let's say you've had a policy for a long time, or you just bought a big policy or whatever, and you got $1 million, $5 million, whatever the number is. You have a large death benefit, and it's going to go to really young kids. We're talking 18-year-olds or younger than that, or whatever. It's like, I forgot how they say it, but the brain isn't fully developed yet at that point. And so in a scenario like that, if you, as the person who owns the policy and started it, wants to instill a level of control while you're alive, for even when you pass away, that's where trust can come into play, because you can set the rules for what that money can be used for and even how much. And so that's something that, although I'm not an attorney or anything like that, within my network, I can definitely get you connected with the right people as well.
Okay.
Yes, Danielle.
So I also have, and I think I may have shared this with you, but I have two things that I want to transfer over. One is, I believe it's a Roth, or it's a 403B, something like that.
Oh yeah, yep, 403B. Kind of,
Okay.
You worked in the education world or something like that?
Yes, yes.
Yep.
And I have this little policy just sitting out there doing nothing, and I'd rather take it and move it to a life insurance policy and let it grow that way, because my advisors do not advise. They're not doing anything, and the money's just sitting there. I haven't contributed to it since I left the district. So I want to move that, for one. The second thing is, I have a term life insurance policy that I have had for years. I have not gotten rid of it because I've paid into it for a long time. I do know that at the age of 70, if I'm still here, which I plan to be, that policy goes away, and I've paid all this money into it. So once I looked into having it converted, but the amount that they were telling me I was going to have to pay was just extraordinary. Anyway, I was hoping you could give me some advice, and we can talk one-on-one, but can you convert a term life policy into a whole life policy?
Let me start with that question, then I'll loop back around to the 403B. The answer is sometimes. And the reason I say sometimes is because some life insurance companies, they have what they call a term rider, or their product specifically is called convertible term insurance, right? And so that allows you to be able to convert into a whole life policy or IUL or what have you, only at that company, at that specific company. Other life insurance policies or term policies don't have that convertibility rider or that option. And so that term is just that term. And so my recommendation for figuring out for you whether it's convertible or not is I would pull up the illustration or go to the life insurance company, call their 1-800 number and say, hey, will you send me an in-force illustration? They'll send that over to you, or it's just going to be in the portal. And I normally would control find the word convert. If we don't see the word convert anywhere in there, it's typically not convertible. But when it comes to doing the conversion, again, it does have to happen at the company that you got it at. In other words, they want to keep your business. So, yeah. Does that help answer that question?
It does. It does. And it must be convertible, because the company is the one who told me that. They told me how much it would cost for me to convert, and it was a ton. And I was like, of course, that was in 2021, 2021. Yeah,
sure. And that, to that point, that's where my literally thousands of conversations over the years have come into play, from a standpoint of, on one hand, it's easy to say, here's what it would cost to take that death benefit and put it over here. But I also want to get a sense of, what are you looking to do with the whole life insurance policy? And so that's where I have that sort of a conversation. Therefore, we can apply for the right type of policy with the right numbers, with the right flexibility upward and downward. And then with that, you may see it doesn't have nearly as much death benefit. But once you make a conversion or what have you, and I've personally done conversions on my own term insurance policy, it actually just reduced my term insurance premium, which is great. And I was able to still keep that policy, except lower death benefit over here because some of it transfers to whole life. And then I have a death benefit over here in whole life that continues to grow. So it just kind of worked out well in that sort of a way.
Okay.
Happy to touch base on that too in greater detail offline. To the point about the 403B, excuse me, with that, I think the question was, can you convert it, or no, can you transfer that into a life insurance policy? Was that the question?
Yes.
Okay. The answer is kind of, not directly. What I mean by that is, you would have to take a full withdrawal of that 403B And if you are under the age of 59 and a half, not only would you have to pay any taxes that would be due, but also there's a 10% penalty tax for those who are under 59 and a half. And so some people look at that and they go, okay, big deal. Like I'm going to create more money in my business anyway. Where other people look at that and go, I hate that. I never want to do that any day in my life. And so it all depends on you understanding the results of doing that. And then from there, if you want to keep it growing for the rest of your life and life insurance to utilize it for whatever you wish, that absolutely can happen. Does that help?
Yes, yes, it did. Thanks.
Okay.
Okay, I got a question.
Yep, go for it. Mm-hmm.
Okay, so in other words, and that pretty much you have to see 60.
Ultimately, yes, that's true. You were kind of cutting in and out there, but yes, she would have to wait till she's basically 60 years old if she wants to make that transfer or withdraw and then deposit without the extra penalty. And that really boils down to how the IRS codes those two types of accounts. Not to get into the nitty gritty, but with the 403B, same tax structure as 457 plans or 401ks or IRAs. They're taxed on what's called a last in, first out LIFO basis, whereas life insurance is tax-free, taxed on a FIFO basis, first in, first out basis. And so the IRS is ultimately just saying, hey, we want you to be able to have whatever you want, but they also are going to say, play by my rules. And so it's just one of those things where it's like, I guess I'll play by your rules, you know. Great question. Great question. One of the things that I didn't share from like a specificity perspective, and I was thinking through that, and I'm like, I think it'd be helpful to share, and it will take me like 3 minutes, 2 minutes, if that, to share, is with that life insurance policy that I shared earlier and on the slides. One of the things that I realized I should probably add is simply the fact that what is that minimum premium, right, for that particular client, quote unquote. So let me share my screen. This is no one's like information or anything like that, but I think it'd be helpful to walk you guys through this one. So this is, I just used the Excel version earlier. This is like the actual pretty, quote unquote, pretty illustration. So you're seeing the same numbers, $12,000 per year. This so happens, if you're wondering, to be a Penn Mutual life insurance company, male, age 45, second best health rating. So anyways, $12,000 per year. The question then is, well, what's my minimum? Because you mentioned like overfunding and that's optional and this and that, but like what is the actual the minimum? Like, oh, I mentioned that. So let me actually go, I think it's, I don't know exactly what page it is. Let's do total. Yeah. So for this particular policy, the minimum premium for the year would be about $2,700 per year. And all of the additional capital that gets them to the 12,000 is all optional. Now, the more you contribute, the greater your policy will look, but it is optional from a standpoint of, I don't know about you guys, but life happens sometimes. Like sometimes life is amazing. Sometimes life is like, what the heck just happened to me, you know? And so with that said, when those financial life happenstances occur, you know that you're not obligated to the full 12 grand a year, only this 77 as an example here. Does that make sense? And so to that point of overfunding, all of this EPPUA, as you see it, we don't have to get all into the particulars, but all of this is overfunding. And so what overfunding specifically means is anything above and beyond your minimum premium. That's what that means. Hope that was helpful, and hopefully I didn't confuse the issue with that. But I thought it was like bothering me in the back of my head that I didn't share that yet, so I wanted to make sure I shared. Any other questions or even comments, just things you wanted to just kind of discuss?
Well, yes, I have a question. Can you hear me, Demetrius?
Yes, I can. Mm-hmm.
Okay, so I'm 43 and I recently had a stroke. And so I was wondering, how does my recent stroke impact cost or even being eligible for this type of insurance?
For a stroke, I'm going to speak in generalities because I'll have to run it by my underwriting team. But generally speaking, if you had a recent stroke, that can make it a lot harder to get life insurance. And even if you can get it within the next year or so, they would add on either what they call a table rating, which makes it a little bit more expensive by maybe like 10 to 20%, or a flat extra amount for a short season, like 3 to 5 years, something like that. Otherwise, in short, the life insurance company they're saying, okay, we would like to insure you, but we want to account for our risk that we're taking on to insure you, because they're looking at it from a standpoint of what are they liable for? They're liable for the death benefit that's going to pay out. Even though we talk a lot about cash value today, the life insurance company, they look at it from a standpoint of their liability on the death benefit side. And so that's how they assess approving or not approving someone, is based on health history. And so strokes can make it a little bit more difficult to get coverage, sometimes not getting coverage at all. But I've seen scenarios where, like when I got into, this is a story I'll share. My very first year in the industry, that's when I was trying to be Mr. Jack of all trades and do everything, right? There's this lady who had cancer within the last, I think it was 3 years at the time. And everybody, like I worked in the same building as one of the, top guys in the entire company that I worked for at the time. And he said, if you ever have had cancer, you can never get life insurance ever again. And I go, dang, that sucks. And so then I was like, I'm the kind of guy who decides to do my own digging. So I just called around, I built up a good relationship with my underwriters at the time, and I just had a conversation with her. And I'm like, here's the scenario. Is she insurable at all? And I thought for sure it was going to be no. She actually was insurable. Well, and she did have a table rating, so it was a little bit extra, but that was able to potentially fall off, and she could get reconsidered for a better rating after another 3 years, I believe it was. So I never like to count anyone out, even if a past scenario said somebody may have been quote unquote counted out. So I hope that helps.
I'm glad she asked that question. So what about the cancer? Like, if it's over 5 years, would it still have that table rating? Would it still have that higher?
Oh, great question. Actually, it falls off. No table rating at all. They're going to look at it from a standpoint, and this is, case by case, but they're usually, in my experience, what they're going to look at it and say is, okay, you had cancer, 6 years ago or whatever. Has it come back? And have you followed the doctors or the nurse practitioner or whomever? Did you follow their medical direction pretty much? And if they have, and they've had good health otherwise, usually you can still get coverage.
I have a question. Okay. So can you do a policy on, if you don't, does it necessarily have to be for yourself, or can you get a policy for like your child and overfund?
Absolutely. You actually can get policies on your children. It's relatively simple to do so. There's only one stipulation that I've ever really seen, and it's the fact that if you are, as the parent, are able to get insurance, at least one of the children's parents must have some coverage. Usually it's an equal or higher amount of coverage. Beyond that, it's pretty simple to get policies on kids, and they usually get approved in like a week, as opposed to maybe a few weeks for, generally speaking, adults. It can take a little bit longer to get approved.
Demetrius, can you repeat that? I couldn't hear. Did you say one of the parents would have to have an insurance policy higher than that child, equal to or higher?
That's right. If they're insurable. Like I've had scenarios where both parents, believe it or not, were not insurable. they had a few kids and they were able to equally split what they otherwise were going to put on their policies, they just equally split that amongst their kids. And so that's something that can be done. But if you are insurable, though, they're going to want to see that you've at least applied for some coverage for yourself.
Okay.
Your kids are adults.
I guess I also want to know, so you can also overfund that policy for your children. Like, okay, like I already have insurance on myself. So if I wanted to get insurance on one of my children, I should be able to do that, is what you're saying?
Depending on the total amount of coverage you have, that may limit the total coverage that the kids can have, even when it comes to overfunding. But usually that's not an issue. Like I view myself as, yes, I'm an insurance advisor, but I view myself as a strategist because I want to put the pieces together in such a way that we're able to accomplish exactly what you're looking for. So I always like to work smoothly in that way, as smoothly as I can. Adult kids, kind of how it works with kids that are adults. How it works there is it depends on who the premium payer is, and where they are at in their life. So let's see, when was this? 2 weeks ago, something like 3 weeks ago. Anyways, there's a family I'm working with right now. The situation there is their kids are adults, I think 18 and 22, that age range. And in that scenario, they're technically still dependents of their parents. And so they're going to quote unquote underwrite or approve these kids almost as if they're like juveniles because they're dependents. And so that's important because if they were fully independent, then the amount of coverage that one can get or the premiums and all that is going to be based on their income, the child's income. But all of this underwriting and approval that we did ended up being based on the parents' income because of the kids were like college age. But if they're way older than that, or perhaps they're gainfully employed in that age range and they perhaps are working and not in college or something, they're going to base the premium amounts on the premium payer, which would be you, and they're going to base how much death benefit the kid can get based on the kid's income. I know that can sound a little confusing, but there's a couple of different factors that they're looking at when it comes to approval.
She was talking about taking a policy out on her child because she already has insurance and she wants to know, can she overfund her child's policy that she takes out?
Yeah. So the answer is yes. She can overfund a policy on her child. And then the only thing that I would consider when I'm looking at it would be how much coverage does Keisha have right now, and then how much is she looking to overfund for the kid? Because for kid policies, it purchases more death benefit per dollar, and so that could put the kid into a category of more highly insured than Keisha. And so we strategize around that, where I've had scenarios where the dad ended up getting more coverage on himself to make it work for the kids. And I've had scenarios where we just reduce the premium for the kids to make it work. So either way is workable. And to answer the question directly, yes, it is possible to overfund kids' policies. Yep.
So I have a question. I don't know if anybody else would have a question like this. You did show us an illustration for a policy with a premium of 12. Well, I saw what the regular premium was, 2,000 something, but what they were paying a month was $1,000 because they had a $12,000 premium here. If someone had, like I've already talked to you or emailed you about what I'm looking at doing, if someone had, maybe they want to put do $500 a month versus $12,000 12,000 a year or 1,000 a month, if they want to do half of that and 500 a month, can a policy with a lower premium like that build or actually be a strategy to build an overfunded policy?
Yes, absolutely. So the way I tend to look at that is, if let's say, for example, it's 500 a month, 6,000 a year, there's two ways to look at that one. The first way would be your ceiling, your maximum for that policy. So happens to be 6,000. And from company to company, there's a certain amount of death benefit that has to be purchased. It's like a minimum amount of death benefit. And so doing $500 a month is above that in most cases, which is good. So that's one way to look at it. The second way to look at it is perhaps, 500 a month is around what kind of like that medium or smaller amount that you're looking to put in, with the option of contributing more. And so I'd maybe raise the ceiling, but only illustrate 500 a month. Therefore, maybe the first 3-4 years you're doing $500 a month, and then things shift within business, things shift within work or what have you, or maybe there's an influx of capital that came through. You now have the option to contribute 800 or something like that. So does it work at that number? The answer is absolutely yes. Now, if you were like 70 years old, that'd be another story, because then it's like that cost of insurance. And I've seen this for like a 70-year-old, maybe like, anyways, it didn't quite work. And I didn't feel comfortable helping them with that policy. It just wasn't going to work for them in the way that they want it. And so it'll work in your scenario for sure.
I have a question. I just want to clarify, because sounds like I wouldn't be a candidate right now for the policy based on my health. So if I do have term in life insurance, so basically you're saying I don't necessarily have to have a whole policy with you, but my child can still be able to overfund him and have policy.
That's right. That's exactly right.
Okay.
Yep.
Awesome. Thank you.
So guys, I put my name in there, my email address. You can email me directly, and I put my booking link in there too. So that's just an initial 20-minute call, because typically how it'll work is I would have just a quick 20-minute call with you, and then as long as it makes sense to connect again, I would normally just schedule a 45-minute video meeting similar to this for us to be able to delve into the numbers a little bit more at that point. And so a lot of what I shared today, I could share it more specifically to you, for you, in a meeting as well. Okay, so therefore it's applied specifically to you and kind of hits home a little bit better. So this was fun, guys. Danielle, you are so great. You are so sweet. I appreciate you. This was fun, and everyone else, it was so good to meet all of you. You have incredible questions, and it'll be more than my pleasure to serve all of you in your families and kind of help from a standpoint of cash accumulation and generational wealth. And I tell you guys, like, I know I'm working the industry and all, but man, I don't know about you guys. I have a Christian background. I'm just going to say that out loud. And when it comes to what the Bible tells me to do, when it comes to like generational wealth, creating wealth for your children's children and leaving an inheritance, I don't know what it is, even though I will never see that because I'll be dead. It just matters a lot to me. And so if I can help do that for others as well, whether it's for that or for other reasons, I'm here to help in any ways that I can. So.
Well, I appreciate you, Demetrius. I told them you're a great guy. I found you on YouTube.
That's right. Yeah.
and reached out to you.
Yeah. Now this is giving me inspiration. I'm like, I've been so busy, but that's not an excuse anymore. I gotta put out more videos on YouTube channel. I got I think 9 ideas that I started. I got to put them all out there, but this one will make it easy. It's already recorded. We'll put it out there. So.
Okay.
Okay, good.
So I will be in touch. You put everybody, did you get that? He put it in the chat, his calendar, if you're interested in scheduling. And make sure that get it. Go ahead.
I'll send you an email with that information as well, so you can send it off to people as well. Okay.
Okay, will do.
All right. Well, folks, this was so fun. God bless you all. Have an incredible evening. And again, I'm a quick email away, and I'll be happy to help.
All right. It is 7:11.
Thank you so much. Thank you.
Yeah.
It's my pleasure. It's my pleasure. God bless you guys. I'll see you.
All right.
All right. Bye-bye now.